we're going to do the loan agreement. This is basically the Bible of the loan transaction. It's going to be the lengthiest document. It's going to set out the key terms, and it's going to paint a picture of what's going on in the transaction. So the loan agreement is going to set forth the major business terms. We're talking the amount of the loan, the type of loan. So there's three major types of loans that I want to talk about. Okay, the note under the loan.
Welcome, and thank you all for joining us for another Justia webinar. My name is Nina, and I'll be the moderator for today. Now, to kick things off, I want to go ahead and introduce our speaker, Jake Rome. Jake is a finance attorney working in Chicago, Illinois. He has experience representing institutional leaders in upper middle market syndicate loan transactions, particularly in the health field. Now, the webinar presentation that you're about to watch will be approximately 1 hour, and then Jake will be joining us live to take audience questions. If you have any questions that come up that you'd like to ask Jake during the presentation, please feel free to submit them through that Q&A button in the control panel at the bottom of your screen. Now, without further ado, here is Jake to discuss understanding loan transactions for the non-finance attorney.
Welcome to Understanding Loan Transactions for the Non-Finance Attorney. I'm going to be your presenter. My name is Jake Rome. I'm a finance associate and I work in Chicago, Illinois. The firm I work at primarily deals with debt financing transactions, and we represent a lot of institutional lenders. We specialize in healthcare lending, so lending against nursing homes, small hospitals, etc. The purpose of today's webinar is going to be directed towards attorneys who do not frequently come into contact with loan transactions. And I wanted to put this together because I know that the documentation process can feel opaque and a little arcane. We use a lot of technical language that non-finance attorneys don't come into contact with frequently. So we want to kind of demystify a little bit of that process. And I wanted to do this because I'm a younger attorney and I could still kind of remember what it was like getting into this field. And I still have a fresh memory of a lot of the questions that I was asking when I was in the training process and first coming into contact with these loan documents. So I feel like I'm in a good position to answer a lot of the intuitive questions that you may have. So we're going to start by going over some instances of when you may actually encounter loan documents as a non-finance attorney. And it probably will happen more frequently in your career than you might originally think. So the first one is going to be you run a small law firm. You have a client who's a longtime client, and they're going to be buying their first or maybe even their second home, and they want your assistance in that process. And this is going to lead to you reviewing mortgage documents. Most home purchases involve a mortgage. Here, you may actually review a few different types of loans. The standard mortgage is going to be a term loan. We'll get to that later. And then a HELOC, or a second reverse mortgage, is going to be a non-revolving line of credit. We're going to get to that later as well. So we're forecasting a little bit of what we're going to get to later in the presentation. The second instance in which you may come in contact with loan documentation process as a non-finance attorney is going to be if you have a client who is also a small business owner. So we're going to touch on a few SBA loans that you should be just generally familiar with because they're both really popular and could easily come up in your practice. So the first one is going to be the SBA 504. These loans are given to what's called owner occupiers. So these are all real estate mortgages, and they're going to be given for non-investment properties. So you have a small business client and they're going to be buying their first commercial space. The SBA 504 program is a very popular one. I've encountered this a lot, not just in my finance practice, but also when I used to do commercial real estate transactions. I've seen the 504 program be used to great effect to a lot of small business owners. It's a really great program. One of the attractive features of the 504 loan from the SBA is that they're all fixed term or fixed interest, meaning that they really do a great job for small businesses because small businesses have very specific cash flows, and the fixed interest loan allows them to forecast 5, 10, 15 years out exactly what interest they're going to be paying so they can budget the entire loan up front. The second SBA loan, real quick, that you should be familiar with is a 7A. It's a little less popular than the 504, but still very common. And these could be used for a mixture of purposes. So either commercial real estate or to supplement working capital for a small business. These are typically a variable rate interest. So it's a little bit trickier for a small business that's tight on capital, but still a very attractive process. And even though it's a variable rate, the SBA gives such favorable rates compared to a private lender that usually it's still very attractive. The last one we're going to look at is maybe you have a client who is trying to make an investment. These are a little less common, but let's say you have an estate planning practice. You have a client who's a high net worth individual. Maybe they want to deploy a little bit of capital in chasing higher gains. So maybe they want to loan a company a convertible note. So debt. Maybe the opposing party is going to prepare the debt documentation first. You get it on your table. Your client asks you to review it. You should have some familiarity with what the loan documentation process looks like for that purpose. Private capital, those funds are getting bigger and bigger, and they're becoming more and more accessible to the retail investor as well. So this could be something that you see happen more and more frequently over the next 2 to 5 years. So what I'm aiming to illustrate with this presentation is that this is not a process that you should be unfamiliar with. There's going to be times in your career as an attorney where you may be asked to review loan documents either as a first review on behalf of one of your clients, or even if you're in litigation, perhaps you get a lot of discovery and some of that discovery involves loan documentations. You should be generally familiar with what you're looking at. So that's what this presentation is geared toward, not to make you an expert, not legal advice. So we're going to start here with the anatomy of the loan documentation package. And the first branch on our decision tree is going to be, are these documents Laser Pro or are they attorney prepared? And this is important because whether or not they're Laser Pro or attorney prepared is going to give you some clues into the underlying structure of the deal, what's happened prior to those landing on your desk. You can have a little bit of a sense of background of what exactly is going on in this loan transaction. So Laser Pro are very common, and they're used by many banks internally to generate loan documents. So that's the first thing you should understand, is that typically if you see Laser Pro, they're going to be generated by the bank itself. Here, the bankers simply use a program where they enter in the major business terms, and that program then spits out an entire loan documentation practice. It's all industry compliant. Bankers love it because it's low cost, low mental capital expended in preparing these loan documents. So when are these going to be used? Typically small dollar deals. They're going to be a straightforward transaction. There's not going to be any complex securitization going on, no delayed disbursement, maybe 1 or 2 delayed draws, but not anything that's going to take a lot of review on an ongoing basis in order to administer the transaction. And because they're PDFs, you can't actually go in and redline these documents. That's another important thing to understand, is if you want to make any modifications to a Laser Pro document, you're going to have to prepare a standalone rider that will be attached at the closing. So again, typically, if you're seeing a loan document package prepared on Laser Pro forms, that's going to be indicia to you that the bank opted not to use outside counsel. And as such, you should understand the mindset of the banker who prepared those documents is going to be a little bit more risk averse. They're not going to want to do a lot of back and forth negotiation, because every decision they make in terms of modifying those documents, you have to understand that they don't have an attorney over their shoulder. So they can't really go to their counsel and say, hey, look, we're negotiating these documents that you didn't perform, and I know that we don't have a contract in place for this deal. Can you advise me on this? That's not really how the process works. Each time that a bank uses outside counsel, typically that contract's going to be negotiated ahead of time. They have a lump sum arrangement or some other fee structure in place. So if they're using Laser Pro, that's not there. You should understand that. So don't take it personally if they push back. You should also note that the SBA prefers to use Laser Pro or some similar form on that. Typically, SBAs are not going to be bespoke documents. So moving on to the attorney prepared documents, that's basically going to be the inverse of the Laser Pro. Typically, these are not going to be PDFs. They're going to be Word documents. It's going to be for large dollar amounts, more complex transactions, lots of competing interests. So if you're looking at a commercial real estate property, you're going to use attorney prepared documents if there's going to be multiple lenders on the property. Maybe you're coming in as the senior debt. There's going to be junior debt, maybe even a mezz lender. All of that has to be negotiated very specifically, especially when you're talking about the same piece of collateral. There's going to be more room for negotiation in attorney prepared documents. We can do more of that wordsmithing that we as attorneys love to do, adding in the word material or reasonable all over the place. That's more doable in this universe compared to the Laser Pro documents. And I say that still against a backdrop of you have to understand that a lot of due diligence and credit approvals go into getting the document into that final form where you're going to be reviewing it in the first place. But it's important to keep in mind that there's a little bit more play in the joints when we come to attorney prepared. So now we're going to move on to the actual documents. Again, we're going to do this at a very high level, just so you have basic understanding of how each one works and how they kind of function together. So starting, we're going to do the loan agreement. This is basically the Bible of the loan transaction. It's going to be the lengthiest document. It's going to set out the key terms, and it's going to paint a picture of what's going on in the transaction and how all these documents, which we call ancillary documents, fit together in the scheme of what's going on. So the loan agreement is going to set forth the major business terms. We're talking the amount of the loan, the type of loan. So there's three major types of loans that I want to talk about. So here we're going to go back to what I said earlier about the mortgage. So a term note or term debt is your standard mortgage. So you make a principal and interest payment every month. Usually on a mortgage is going to be a fixed amount, so blended principal and interest over time. The second type is going to be what we call a revolving line of credit. The word revolving basically means once you pay down the principal, you can reborrow it. So think about the credit card that you have. That's a revolving line of credit. And the last one is going to be a non-revolving line of credit, meaning that you get a note, you can borrow up to a certain amount, but once you borrow that amount and you pay it back, you cannot reborrow it. So that's the difference. And the difference between a non-revolving line and a term note would be that the term note is typically going to be dispersed all at once, as opposed to a non-revolving line where you can make draws on it over time. So I kind of touched on the repayment schedule, but those will be set forth in the loan agreement as well. Important thing about a non-revolving line is when do you pay the principal? That will be put forth in the loan agreement. Typically, there's two major ways that you repay principal on a non-revolving line. You should check in the loan agreement to see which one it is. That's important information for your client. So the first way would be at some point the note converts. So you have what's called a draw period. So let's say you get a non-revolving note. You can draw for 36 months as an example. At the end of the 36 months, whatever you've drawn down converts into a term note, and then you get to pay off that term note over time. The other way would be at the end of the draw period, that 36 months, all of the principal is paid and you're just paying the interest throughout the draw period. So two different structures, very similar. The balance due at maturity is what you're most likely to see in a HELOC. So that would be a good thing to keep in mind and to let your clients know about. So speaking of maturity dates, I've thrown that phrase around a little bit. Maturity date just means typically the date at which everything has to be paid off on the note. So for a revolving line of credit, sometimes you can see that maturity date get renewed over and over again. Typically, that's going to be an ongoing concern between the bank and the borrower. The next thing in the loan agreement, it's going to tell you interest rate. It's going to tell you how is the debt going to be priced. Typically, this is going to be a benchmark. There's very common benchmarks. Up until a few years ago, it was LIBOR. Probably have heard that a lot. Now we have switched to what's called SOFR. It's a much more transparent pricing system than LIBOR was, hence why it's been dispensed with. Other rates that you'll see would be federal funds rate set by the Federal Reserve, prime rate, very similar. So the interest rate is an important one that's going to be set forth in the loan agreement. Next in the loan agreement, we're going to see what constitutes a default and what are the lender's remedies upon default. Defaults, typically the most common one is non-payment. If your borrower doesn't pay, that will constitute a default under the loan agreement. Remedies in a situation like that would be able to accelerate the debt. So if you have a maturity date that's 3 years out, but you're not paying it, well, then the bank or the lender will be able to accelerate the debt. Now it's all due and owing now. Other common defaults will be non-compliance with different financial covenants or reporting requirements under the loan agreement. We'll get to that in a second. Other lender remedies will be things like liquidating collateral. So if you have a mortgage, you're secured against the home, be able to put it into foreclosure, sell it, and recoup some of your losses. Okay, so now we're going to turn to another crucial part of the loan agreement, which is reporting requirements and covenants. These basically relate to information that the lender is going to want throughout the course and the term of the loan, and certain behaviors that they want the borrower to either refrain from or comply with throughout the term of the loan. Reporting requirements, gathering of information, covenants, refrain against a negative covenant, or do certain things, a positive covenant. So I included a handout that will go into a lot more depth, but I'll hit some of the high level concepts and go into some examples here as well. So reporting requirements relate to information that you want to get as the lender on a regular scheduled basis throughout the term of the loan. So if we talk about a consumer borrower getting their first or second residential mortgage, the big thing that the lender is going to want to see on an annual basis will be a set of their tax returns. There may be more frequent reporting requirements applicable to a consumer borrower, such as a personal financial statement, which may be requested at a 6 or 12-month interval, basically just demonstrating that the borrower is in the same or better financial position as they were at the time that the bank wrote the loan and gave them the money. It's important to note that a lot of these covenants and reporting requirements, if the borrower has, for any reason, missed the mark. So typically the way that these will be written will say, without demand or request from the lender, every year after the borrower files their tax returns, but in no event any later than April of every year, because that's when you have to file your tax return. The borrower shall give a copy of their personal tax return, both federal and state, to the lender. If, let's say, May rolls around that year and there's a persuasive reason that the borrower has not been able to file their taxes, maybe they're very complicated, maybe somebody messed up their W-2, then they should, before actually breaching that covenant, because typically there's a little bit of a grace period, reach out to the lender. Usually it's not going to be an issue. But again, here, the more communication that the borrower keeps open with the lender, the better this is going to go. So I talked a little bit about what they might want from a consumer borrower, but if we talk about what kind of information the bank's going to want from a commercial or a corporate borrower, that gets a little bit more in the weeds. So for a corporation, they have much more complex financial statements or financial accounting. So they're typically, the lender is going to want copies of their cash flow, balance, and income or profit and loss statements. So the big three on a rolling basis, maybe monthly, but usually quarterly and then annually. Quarterly financial statements can be usually company prepared, so internally management prepared, or if they have an accounting department, prepared by their accounting department. But the annual financial statements for the trailing 12-month period, typically the lender is going to want to see that they're either reviewed by an independent accounting firm or audited with an unqualified opinion by an independent accounting firm. Other types of financial reporting that they'll want from a commercial borrower, if they have tenants, they'll want to see sort of the payor mix of those tenants. So this might be something that they don't want from a smaller commercial building, but if it's a large commercial building, they'll want to see that their payer mix or their tenant mix is a little bit more diversified, that they're not all the exact same type of tenant. So if that particular sector or industry takes a little bit of a slump, then the commercial property is not going to go under. So that gets a little bit arcane or a little bit esoteric, but that's something to be aware of when they say like a census data or a payer mix. Other financial statements that they might want from a commercial borrower would be if they have a guarantor. Now we're going to look a lot like what we are requesting from a consumer borrower. So things like tax returns, personal financial statements. There may even be covenants that apply to a guarantor. So now we're getting a lot more similar to a residential mortgage. So I mentioned covenants. Let's turn to the covenants. So affirmative covenants will be things like financial covenants. For a individual borrower under either, you usually won't see this in a residential mortgage, but you might. But an individual borrower who's acting as guarantor for a corporate borrower. That would be things like tangible net worth requirements, or a free cash flow requirement for an individual. So you're not getting all your money tied up in, let's say, stocks or bonds, or even less liquid or more illiquid assets, like a 10-year treasuries. Like if you just put all your money in 10-year treasuries one day, that's going to be a problem for the bank. Other financial covenants that will be actually applicable to the corporate borrower will be things like debt service coverage ratios, or a fixed charge coverage ratio. So that will basically be testing how much free cash have you generated that is available to cover all of your debt payments for a certain period. So that might be quarterly. We want to see what was your EBITDA for that quarter, and we want to see how much did you generate and how many times could you have paid your debt with that free cash if you had to. So that's just a test of financial health. If we go into more negative covenants, things that you have to refrain from, that's going to be things like if you have an anchor tenant in your building, one that's sort of the lodestar that's going to be supporting a majority of your cash flow, there might be a covenant that says you can't terminate that tenant without first asking for the bank's approval. There's going to be there's going to be covenants that prohibit you from doing prohibited transfers. So if you're a corporate borrower, you can't sell a ton of your stock of a principal. A principal can't sell a ton of his stock to some unrelated third party without the bank's approval. This is because usually in a corporation, there's going to be a couple of key men who really understand the business and who drive a lot of profits. The bank wants to ensure that those people are going to stay there throughout the term of the loan, or at the very least, if for some reason they have to exit the business, that we're going to have advance warning of it, and we're going to have like a say in the process of who a suitable replacement would be. A lot of times when you see a prohibited transfer, it's not anything that's nefarious. It's just for tax planning purposes. So an individual transfers his share or his membership interest into a trust that's for the benefit of him or his children. So those are the type of things that we usually will consent to without much of an issue. If you want more information about negative covenants or specific financial covenants, I'm happy to take those questions. A lot of it is not going to be especially useful to you as a reviewing attorney because it's going to be so tailored to the deal. There's not usually going to be a ton of wiggle room, but it's important for you to have a basic understanding of what they are. And again, I would refer you to the handout, but again, happy to take your questions on that. Okay, the note. So I've said note quite a few times up to this point, but this is the actual debt instrument between the borrower and the bank, and it represents the maximum indebtedness under the loan. I say maximum because under a revolving line or a non-revolving line, it depends on how much the borrower actually draws. Typically, the note will incorporate by reference terms of the loan agreement. So you don't want to actually have to amend the note over and over again. So let's say you need to make changes to your loan documents at some point. Amending the note because you don't want to have multiple versions of a live note floating out there, it can be a little bit of a headache. So if you have to extend the maturity date, you'll do that through the loan agreement, and then the note will incorporate the loan agreement by reference. Mortgage, I've talked about. This is the actual perfection instrument that gets reported. You'll see that in the county recorder's office against the property in order to perfect the lien that the lender has in the property. A guarantee. So if you have a corporate borrower, because the corporate form can't actually perform anything without a live warm body or a human doing it on its behalf, you'll want to get a performance and payment guarantee from the principal of the corporate borrower. So you'll see that this is an important one to review very closely, because if your client is a small business owner, here's where the actual personal liability will come in. So it's very important, especially if you're not used to reviewing things for them as a small business and they're more of a personal client. Here's where the rubber meets the road for your representation. And then there's other security docs. These can vary in how many you'll see depending on how redundant and how thorough any particular lender wants to be. At my firm, we take the belt and suspenders approach. So nobody's ever accused us of not being very thorough in our documentation. So things you'll see will be like a security agreement. This is where the actual securitization of all assets typically comes in. You have what's called a blanket security agreement against all the assets of a corporate borrower. A pledge agreement that will relate to things like certain deposit accounts, certain specific pieces of collateral. You'll want to get a pledge on that. A DACA, or a deposit account control agreement. You may remember from your secure transaction class, the only way to have actual perfected lien in a deposit account is to have a control agreement. Typically, this is accomplished through you having the deposit account at your actual bank, at your lending institution. But if it happens to be held at a different institution, you'll want to get a control agreement in place. And then assignment of rents. This is similar to a mortgage in that it gets recorded against the property, and that it's the only way it can be perfected is through recordation. And this is just used to collateralize a commercial property that may have tenants on site, or a multifamily residential property that may have tenants. And it basically puts a lien into all the future cash flows that are generated in the form of rents. So here is where we're going to get to the bread and butter of the presentation. This is the important stuff. So here's the practical advice that I came up with for non-finance attorneys acting as counsel to borrowers. So the first big thing is know your audience. This kind of goes back to the Laser Pro versus attorney prepared documents that we came up with. That can give you a little bit of a window into the mindset of the banker who is behind the deal. If they're using Laser Pro, understand, like I said, that probably means that they don't have outside counsel assisting them. They may have in-house counsel whose basic job is to just kind of do quality control or on the actual documentations, but they're not going to get into the nitty-gritty of negotiations. First big one. If your client happens to be borrowing from a governing agency, such as the SBA, Fannie Mae, Freddie Mac, or HUD, know that the ability to negotiate loans is also going to be limited. Those are big bureaucracies. They don't like to move with a lot of alacrity. They don't pivot very well. It's not a dig against them, because they do offer great financial products, but just know that they're going to be very limited. They have their preferred forms as well. Those have been, again, fed up the chain of command and approved by a process that involves a lot of red tape. So they're not going to negotiate too much, maybe a little bit on the margins. The second big picture item would be to confirm every business point that you're able to. This is a big one, because I can tell you that even though we strive for perfection, banking attorneys, we are human. So there are some mistakes that can be made. In my experience, I've not encountered a lot of lending attorneys that are trying to pull any quote unquote fast ones. So if in your process of review you come across a discrepancy, always raise it. It's always worth asking. Sometimes, it'll be there on purpose, but typically not, it, and we're very easy to work with. Especially for litigators, I find that this is good advice because they're not used to business transactions a lot. In litigation, it is adversarial. In transactional law, it is much more collaborative. We're both motivated to get the deal done. That's how we make our living. So always, raise your hand and ask. You may be asking, how do I know what to confirm? That will be where you should ask your client if they received a term sheet. Term sheets are basically, one or two sheeters that set forth all the things that I hit in the loan agreement when I said loan amount, loan type, maturity date, interest rate, even sometimes financial covenants will be in the term sheet. If your client didn't give you one, that's an important thing to ask because you can use that as essentially, a guidepost or a Rosetta Stone to just go through the loan agreement and check things off. Next big picture item, act as a liaison. So there are things that I as lending counsel just can't possibly know about your client. This is going to be things that you would be in a better position to ask about. A lot of times, if I get a batch of corporate documents, such as articles of incorporation or an operating agreement on a borrower, they might be a little bit stale, and I have no way of knowing. For a lot of commercial loans, typically, the process takes a while, so it could be anywhere from 3 to 6 months by the time that the deal is, all the terms are negotiated and gotten through credit approval with the bank. And there are a lot of changes that can happen in that interim time that I might not know about. For instance, something that we're encountering a lot these days is Israel just recently changed their tax laws. A lot of my clients will be, Orthodox Jews, and they will have family that they repatriate to in Israel. So it's caused them to all convert their LLCs into limited partnerships. I have no way of knowing which ones do unless the borrower's counsel tells me. So things like that happen all the time. You have management changes at a company, and now the board of directors looks totally different. All the officers look different. So here I am putting a certain name and title in a signature block. I have no way of knowing unless borrower's counsel tells me. So those are important things. And I think that, there are other things that you should be aware of as well, such as if there's a mortgage, whether it be a residential or a commercial property, always double check things like legal descriptions, PINs. There was a spell a few years ago when enhanced 911 was a big thing. That was when a lot of municipalities decided to renumber their city streets so it was all consistent throughout the city. So if there was a call on at a certain street or a certain parkway, police and fire would have a better idea of which way the numbers ran, even if they hadn't been to that area of town before. Well, I think it's a great idea. It's definitely worth doing, but it changes a lot of house numbers on old documents that may be pulled from the recorder's website. And I don't have any personal way of knowing that street number or even street name, because part of enhanced 911 as well was renaming, if there was a Park Avenue and a Park Street, they would change the name as one of them. So I have no way of knowing unless borrower's counsel has a dialogue with his client and lets me know. Another important way you could act as a liaison is just from a sheer due diligence process. And this benefits not just me as lender's counsel, it benefits your client. So ask thing about, in terms of any property that's been owned, has there been any environmental site assessments done recently? This is important because if the answer is yes, and I don't know that, then we can actually add that information into the loan document. So we'll carve it out of what's called an environmental indemnity. So a lot of times we want borrowers to take responsibility if anything bad happens on the property from an environmental standpoint, but we can say, we've reviewed the phase 1 examination that was done in 2016, and we're going to allow a carve out from those environmental indemnity obligations for everything that's contained in that report, and we'll incorporate it by reference. So that kind of information gathering from on your part will do a lot of good for your client in terms of limiting the scope of their liability, limiting their risk exposure, etc. Another thing that you can ask about the property will be ongoing construction. This is important because in terms of when we get closer to the closing date, and if the lender is getting a loan policy on the property, from a title clearance standpoint, we'll need to know that construction has not been ongoing on the property for at least 6 months. And if it has, then there are steps that we have to take in the interceding weeks and months before closing in order to make sure that that's documented properly and that we're not going to create any undue risk for the lender or the title or your client. So I've had more than once these types of things spring up the week of closing, and it's kicked out the closing date for another 3-4 weeks. And at that point, nobody's happy because this was a solvable problem had we just had a heads up earlier. So those types of things are very important. We'll need to know who has been doing the construction on the property as well. If you can get us contact information for the actual contractor, that way we can get lien waivers in process and get all that documentation assembled over a title so they have a chance to review it well ahead of time. So these are just little things that you can do to better represent your client and to make them feel happy about your representation of them. Again, similar to the EPA site assessments that I referenced, recent surveys, recent zoning reports, there again, no way of knowing by looking at, let's say I get a zoning report, it's dated from 5 years ago. If there has been a zoning change in that municipality in the interceding years, I have no way of really knowing unless your client shows me some updated documentation to make sure that they are still grandfathered in or that the zoning regulation changes has not affected their property. If your client is cognizant that there have been recent zoning changes, but they don't know the answer, that's a good way to tip them off that you're going to want to figure that out now because it's going to be a problem. Once we get closer to closing, title companies are pretty good at their job, and they're going to figure out that those zoning changes happened. And if we haven't thought ahead and planned ahead, then again, this is one of those things that can delay closing. It's going to be a hard one for us to waive or just do post-closing. So they can always get what's called zoning letter from their municipality that will just basically say that you are still in compliant as of this recent date. Again, if your client owns a piece of commercial property, one thing that changes frequently is tenant turnover. So we will want to know that the tenants that we underwrote against back, 3-6 months ago for our credit approval are still the tenants on the property, or if they're not, we'll want to know who the new tenants are, and we'll want to see copies of their leases to make sure that they're on similar payment terms as the prior tenant that we underwrote against. So again, it's always helpful to just have somebody who is not only in their client's corner, but is going to make the whole transaction run smoother by just keeping an open pipeline of information. I think a lot of attorneys, especially if they're not used to loan transactions, get a little bit intimidated by the loan portion of it and forget sort of the fundamentals of just representing and what constitutes good representation. So again, fact gathering, information and document gathering, and open pipeline of information. And this again is not only directed at my litigators, but especially at litigators. They tend to be very protective of information, which I think is very helpful in a litigation context, but maybe a little bit less so in a kind of more mutual goal-oriented transaction like a loan. So 2 major obligations that I wanted to touch upon that every borrower counsel should be aware of would be what's called the certificate and resolution and opinion letters. The certificate and resolution, pretty straightforward document, but it's for the authority to make sure that a corporate borrower has properly authorized the loan transaction. This is another area where you could do us a lot of help by reviewing the operating agreement or bylaws of a corporate borrower to let us know exactly what steps need to be gone through in order to authorize a loan transaction. You may remember from your BizOrgs class that certain major decisions taken by a corporation need to have authorization of not just the managerial staff, but some percentage of the actual interest holders or equity holders in the borrower. So sometimes borrowing a large sum of money would constitute a major decision for a corporation. If you don't do this part, we're going to do it. But a lot of times it will save us money and vis-a-vis your client money, because a lot of times borrowers have to pay the loan counsel's attorney's fees to just head off this at the pass, and just say, hey, look, I'm going to direct your attention to Article 7 of this operating agreement. You'll see here that they need to get the consent of equity holders. I've already gotten that process underway. If you don't do it, I will find it, but it's very helpful and it's going to potentially save your client some money. The resolution part of that, again, just goes back to what I was just saying. The certificate part of that is going to be from a officer or manager of the corporate borrower. It's going to be like a one-sheet piece of paper just saying that the articles attached here to as Exhibit A are still in effect, have not been amended, and are on file with the, let's say, my home state, Illinois Secretary of State. Attached here as Exhibit B are going to be a true and complete set of the bylaws or operating agreement, depending on their corporate form. Those have not been amended, or if they have been amended, all amendments are included as well. And then Exhibit C is going to be what's called a certificate of good standing. You can get these from the Secretary of State's website. If you don't know how to order one, ask me. I can either order it for you or I can tell you how to do it. There's no upcharge on a certificate of good standing. They're pretty cheap. So now let's turn to the opinion letter. This is a pretty important one. A lot of borrowers' counsels get the most cold feet when they reach the opinion letter, because it is an attorney actually putting in writing their legal opinions in not indefinite terms. So we don't really like to do that. We love it depends. So I have a lot of sympathy for borrowers' counsels who have to write opinion letters, but unfortunately, it's just part of the game. That said, there is a negotiation that goes on between the lender, who obviously I want the most number of opinions and I want them to be as concrete as possible, and the borrower's counsel. This is an ongoing dialogue. So common opinions that are included in an opinion letter. And I guess we'll start with just saying why this is important and why it's used. It becomes part of the file at the bank. And basically this is something, if the loan goes south and we find ourselves in court, we can go in and say, once the borrower starts contesting, oh, that's not my signature on there. We didn't properly authorize this transaction. We didn't know that the loan proceeds could only be used to acquire a building. We went out and bought a bunch of margin stock with it. We want to be able to protect ourselves against those things, obviously. So the opinion letter is basically our kind of mini insurance policy against that. So common opinions, proper formation of the borrower if they're a corporation. So that opinion is just from you as borrower's counsel saying the articles provided to the bank have been properly filed and are on file with the Secretary of State of X state. The existence of the borrowers. We have paid all franchise fees that are due under state law. We have paid to have our articles renewed, and they are renewed. And not only were they properly filed, but they are still in good standing. Proper authority. Again, so we're kind of going back to the things that I talked about with the certificate and resolution. So maybe you can start to see how all these fit together. So proper authority of signatory on behalf of the borrower. So that would be if the president signs all the loan documents, the president of the corporation, just saying that the president has been authorized by the board of directors or the shareholders to sign the loan documents as required under the bylaws. Proper execution would be just saying that, all the signatures of the president in the loan documents are actually his signature. You can see that most of these opinions are probably written in blood. So we've come across all the arguments that they make in court, and we kind of want to hit them on. Enforceability of the loan documents and recordable documents. So this is just saying that if the loan documents are performed as they are written, then they would be the enforceable obligation of the borrower. That does not say that they're going to be enforceable if the lender fails to perform, just that if they are actually performed as written, they are enforceable. And recordable documents That's just saying that we take a look at this mortgage or this assignment of rent, and it is in the proper form to be recorded in the Cook County, where I'm from, recorder of deeds. That there are no conflicts preventing borrower from executing and performing the loan documents. So this would just be basically, we've taken a look at the corporate records in the corporate minutes, and there are no off the records or off the books agreements that we have not disclosed to the lender that would prevent the borrower from performing these loan documents. Another no conflicts opinion would be that there are not any state laws or obligations of the borrower to get authorizations from a government or a local governing authority prior to performing the loan documents, or if there are, that the borrower has obtained those consents from a government. That there is no pending litigation or threatened litigation against the borrower. That's a big one. We obviously do our due diligence on our own end, and we search all of the local dockets to make sure that there's no pending litigation in the municipalities where it should be filed if it's properly filed. But we obviously can't look state dockets and federal dockets for all 50 states. So we asked that the borrower's counsel to say, I talked to my client. They said there's nothing pending in Florida. That there are no circumstances that would cause a default on day one under the loan documents. That's another opinion that we will often ask for. That the interest is not usurious. A lot of times this is just a simple Google of a statute. Every state has its statute. I think it's 19% in Illinois, which is a usury rate. And our loans, even in our current economic climate, don't go up to 19%. And that any filings of UCCs, or I guess we would include mortgages and assignments, will be sufficient to perfect the bank's lien upon recordation. So that's, again, a simple one. It's more to the form rather than substance of the documents. We're not going to ask you to make any opinions about, is the collateral description correct? Is the borrower's name spelled right? Not substantive, but just take a look at this document. Does it meet the local requirements or the state requirements for perfection? So as I said, a little bit intimidating on the opinion letters, but a very crucial part of the transaction. If you have never written an opinion letter, you should ask me, and I will anonymize one from a prior similar transaction with all the opinions that I'm looking for, and I'll send it over to you for you to just use as a form. And most of us will do that. I'm not going to send you any details from prior transaction, but in terms of what I'm looking for, I'm willing to work with you. And truthfully, I want you to use my form. If you just fill it out as I want, then I don't have to negotiate with you. You may have changes, that's fine too, but most of the time we're willing to work with you because a good result for our client is closing the deal, and a good result for your client is the same thing. And so again, I would treat it as a collaborative process. It can be a little bit daunting, especially when I send you a full batch of documents and it's over 400 pages, but I'm not looking for you to do it overnight or even within a week. I want you to take your time. I want you to make your client, the borrower, feel good about the whole process. And I want it to be correct as well. So if you do catch things, again, I haven't come across a lending attorney that will bristle or take offense to those types of things. Always ask, because you don't know what we might agree to. So now I'm going to move on and see if there's any questions.
Awesome. So Jake is here with us live today. We can now move on to audience questions. I will provide you with a little bit more information about what to do with that code if you need it. But if you have questions for Jake, please feel free to submit them through that Q&A button at the control panel at the bottom of your screen. It looks like we've already got a couple, so we can go ahead and jump right in. Okay, let me pull them up here. Awesome. The first question is, can you clarify the implications of the acceleration clause in the loan agreement and how it might affect the borrower's obligations?
Sure. The acceleration clause basically means that all the debt that is outstanding under the loan from the date of the default through the end of the term. That includes all interest and that's outstanding and accrued, plus the entire principal basically becomes due and owing at the date of the default. And this is basically a way so that lenders can either make a claim in court for the entire debt, or can even make a claim in bankruptcy if the cause of the default is bankruptcy. In essence, where the borrower normally has to make measured monthly payments, and at any given time would only have that next principal and interest payment due, it all becomes due at the date of the default.
Got it. Makes sense. Okay, our next question is, in the security agreement, there's a mention of collateral. How is the collateral determined, and what's the recourse, or what recourse does the lender have if there's a default in repayment?
So the collateral is going to be determined on a case-by-case basis. That will mostly be determined by the underwriting team at the bank. It varies from loan to loan, and it really depends on the purpose of the loan. So a lot of times the collateral will just be a piece of commercial real estate. The recourse or a default on a real estate loan, of course, is going to be the mortgage foreclosure process. Collateral can be extremely specific in terms of specific pieces of IP, could be membership units in the actual borrower itself. For a high net worth client, that could be a brokerage account. And so the lender recourse is obviously going to depend between those different asset classes that serve as collateral.
Got it. Our next question is, I'm curious about the specifics of the loan covenants outlined in the documents. How stringent are they, and what actions could potentially lead to a breach of these covenants?
Yeah, so loan covenants are going to be pretty strictly construed, but the level of enforcement for breach is going to vary and depend on what specific covenant it is. So, for instance, if there's a financial covenant where you have to have a certain amount of cash flow to cover your debt payments, then if a borrower misses that for a financial quarter, but they come to the bank and they say, we had an extraordinary one-time expense occurring in the last fiscal quarter, then that may factor into the bank's decision whether to waive the violation or reserve their rights with respect to that violation. Other loan covenants are going to be even less stringent than that. Like if you have to deliver financial statements by a certain date and you're late by a couple of days, usually the bank is not going to get too upset about that. They might sit and wait and see if that becomes a pattern in practice of behavior, then you might have a problem. So they might reserve their rights with respect to those financial covenants. Other covenants, such as transferring collateral out of the borrowing entity's name, transferring title of it to a different entity, that's going to be a no-go. You're going to want to make sure that you don't do that. So the word of advice to people who are acting as counsel to borrowers is to always say, like, if there's going to be a problem and you see a covenant being breached down the road, just more information is better. Disclose early, disclose often.
Our next question is going to be regarding the guarantee provisions. What are the key responsibilities of the guarantor, and under what circumstances could they be called upon to fulfill on those obligations?
Good question. So guarantee responsibilities, typically a guarantee will have a subheading of being a guarantee of payment and performance, maybe one of the two, but usually both. So payment being like Bob owns a company, and for some reason the company has cash flow problems, they can't make their scheduled payment, but Bob is a person of means, independent. He has an obligation to go and make that payment on behalf of the borrower. Performance, let's say Bob owns a company, but it's managed by his friend Tim. The borrower doesn't renew their insurance policies. Tim either forgets or he refuses to do so. Then Bob, being the guarantor, will have an obligation to go and renew that insurance policy on behalf of the borrower. So these are not things where the lender has to tell Bob to do that. He knows because he signed that guarantee.
And then I think the last question that we have time for is, are there certain loan transactions that you wouldn't recommend a non-finance attorney review for their client?
Yeah, so I mean, the duty of competence always applies in these situations. if any attorney just feels like they're not up to the task or it's getting too complex, you have an obligation to disclose that to your client and either refuse the case or withdraw. There are some that are inherently more complex. If you're working on a real estate deal where there's multiple lenders and there's a mixture of debt and equity on the property and everybody has different rights to different pieces of collateral, those can get really complex very quickly, and they scale in that way. The more lenders you add in and the more different slices of the pie that you have to a certain asset class or piece of collateral. Private credit transactions are becoming more and more common now. A lot of people say we're in the golden age of private credit. So that's going to be different from your traditional institutional lender, where it's usually going to be either a fund or a corporation where this is how they make their money, is by doing private credit. Those can get very complicated quickly because it becomes a mixture of both your traditional lending deal and like a stock purchase agreement. So I would not advise for non-finance attorneys to get involved with that, because the players on the other side are very sophisticated. They usually have white shoe lawyers who represent them, and they don't necessarily have a borrower's best interest in mind, because they are in a position where they can take over the business and basically squeeze all the equity out of it if they have to. And so with banks, what I represent, typically, they want to see the borrower succeed, and they don't want to overlend them that they can't support with the revenues that their businesses generate. So those types of transactions are not predatory, but like they're a little bit more adverse than what I was talking about in my CLE. So I would just be mindful of
I do actually think we have a little bit more time, so we have one more question.
Sure.
What are some common issues you've noticed when borrowers and their attorneys might be less experienced?
I think I would like to go back to being more standoffish, in terms of like, really, I don't have any reason to not want the deal to go through. I'm Like I was saying, we're very deal motivated. And so people being a little bit not communicative with lenders counsel. I'm like always in the office. Trust me, you can call me at any time. And not wanting to share an open exchange of information. Now, if there's like something to hide, then I could get that. But most of the time it's not. It's just are very skeptical of the reasons why I would ask for it in the first place. So I would just say, make us your friends. We want the deal to go through. Usually our clients, the banks, want the deal to go through. And so just be more collaborative. Other common mistakes will be each transaction that we do usually starts off with a checklist. And we, on the lender side, we spend a lot of time preparing these checklists. They're very detailed, and everything that's on there is necessary. There's no fluff on the checklist. So word of the wise to any attorney who is going to be representing a borrower would be to spend a lot of time getting to know the checklist. And that can save you time down the road just by spending that extra time up front. So for instance, the checklist will have all the diligence that we're looking for. It will have organizational documents of the borrower that we're looking for, including articles, bylaw, good standing, which I brought up earlier. It will have all the diligence in terms of if there's any commercial real estate involved or residential real estate. So things like environmental examinations, zoning reports, title, prior title insurance, any of the documents recorded against the property, all that's going to be in the checklist. It's going to be even more precise in terms of if we need to get a new survey for the property. Typically for me, there's a schedule attached to my checklist that has line by line all of the details, all the specifics of the surveys that we'll need to see in order to underwrite our title insurance policy correctly. So these are very specific. Surveys, I'm not sure how familiar any one of you are with surveys, but if you get an ALTA survey, it's going to have what's called Table A items, which are all just very specific items that will get plotted onto the survey, including plotting easements, encroachments, flood zones. It gets very detailed. All that's very important. And I've had more than once a borrower or their counsel order a survey, not check the requirements, and we have to go back and redo it. Same thing with insurance. All of my checklists will have a schedule of insurance requirements in terms of policy limits, aggregate policy limits. There are short form certificates of insurance that have to get delivered to the lender, and that will all be laid out on that schedule in terms of how the lender's name needs to be phrased. A lot of times, like I'm representing Bank XYZ, they'll just put Bank XYZ on the certificate of insurance, when in reality, what I want is Bank XYZ, a banking corporation of Illinois, and its successors and assigns. It's these little things where if you can just spend some time with the checklist, you can head it off at the pass, and now we're not redoing things down the road, and your client's not getting mad at you. I can't tell you how many times we come up to like the week or two before the closing scheduled, and the borrower's attorney will give us a bunch of documents, and lo and behold, the insurance certificates are wrong. And now we're chasing down third parties in order to get these small little things corrected, like putting its successors and assigns on the certificates. So if you can just read the checklist, read it thoroughly, hopefully get as much of it right the first time as we can. That way your client's happy, I'm happy, and we're not scrambling, and we all look like professionals. So that's another very important piece of advice.
Awesome. Well, thank you, Jake, for all of your insight and answering your questions. And thank you all for submitting your questions. As I mentioned at the beginning of today's presentation, as you are all members of Justia Connect, I wanted to remind you again of all of the benefits you can gain access to by upgrading to Justia Connect Pro. So when you upgrade, you do get access to that benefit to get CLE credit for watching live and on-demand webinars just like this one, as well as a $200 credit to help you save on select Justia marketing solutions, an enhanced profile in the Justia Lawyer directory with a pro badge, that ability to feature reviews on your Justia Lawyer directory profile, and so much more. So again, if you'd like to learn more about that, you can go to pro.justia.com. We hope you have a wonderful weekend. Thank you for joining us. Thanks for watching. We hope you enjoyed this video, and if you did enjoy it, please click the like button and subscribe to our channel for more videos on law practice and legal marketing. See you in our next video.